Now that you've earned that money in your 401k, you don't want to make mistakes that could potentially derail your retirement. In this video, I will share with you some of the costly mistakes so that you can make sure that you hold on to that nest egg. Hi, my name is Mark Singer, founder of Your Retirement Authority, and for up-to-date and timely information on retirement, retirement income, Social Security, and all, subscribe to our channel and hit the notifications bell below so you're alerted to when we post new videos. So I'm going to share with you 5 mistakes that I think you should be aware of so that you make sure that you don't step on the same landmines others have. The first mistake, or landmine if you will, is leaving the 401k behind. In other words, when you go to a new job or you retire and you decide not to roll over the money and leave it with your old employer, if that's available to you, that could be a big mistake. Now, for many people who've worked with an organization for many years, they feel very comfortable there. They feel like the organization will take care of them. That's not the case with your retirement plan. Once you leave there, no one's looking out after your plan or going to call you with recommendations, or if the market goes up or down, what you should be doing to react to it. So make sure that once you do leave, either because it's a job-related situation or you're going into retirement, that you take that money with you, either rolling it into the new 401k or roll it into your own IRA. And we'll talk a little bit about some of the things to be aware of when you do roll it over. The second landmine to be aware of is when you roll the money over indirectly. Now, that's a financial jargon term, so let me define that for you. Typically, there is a direct rollover where one financial institution, in essence, moves the money to your new financial institution. In other words, you're working for a company, you roll it over into an IRA somewhere, and the check is made out to the new financial institution, what they call FBO, for the benefit of you. Check's not made out to you. You never really touch the money. The check could be electronically wired to your account or actually could be sent to you. One tip if you do that is don't endorse that check. It's not made out to you. You send it to your new financial institution. That's a direct rollover. An indirect rollover is very different and can cause problems. An indirect rollover is when, in essence, the old financial institution, typically, your retirement plan from the old organization, sends a check to you directly made out to you, where you would then deposit it in your bank account with the intent of moving it into an IRA within 60 days. Because if you don't do it within 60 days, you get penalized. However, oftentimes when the check is done in this way, where it's indirect, withholding can be taken from it. You can forget to roll it over within 60 days. Those are 2 big mistakes that could cost you a lot of money. There are 2 other considerations to be aware of. One, if you are 59 and a half or younger, there are certain IRS codes that allow you to take the money out penalty-free. You lose that option if you take the money in an indirect fashion. Just take the money and don't roll it over. The IRS does allow you to do 1 indirect rollover every 12 months. So my advice to you is, if it is at all possible, do the rollover in a direct fashion rather than indirect. Landmine number 3. Believe it or not, it's rolling over company stock. Now, for many of you who have been with some Fortune 500 organization and you've invested a lot of money into that corporate stock and it's hopefully done well, you may have options to take some of that money out in a tax advantaged way. It's called net unrealized appreciation. Again, another financial jargon. I don't want to go into it right now, but just be aware that there is a way to get some tax benefits on the corporate stock, but not after you roll it over. So be very careful. If you do have a large amount in that 401k in the company stock and you think you may need some liquidity and you want to take advantage of tax benefits, consider the net unrealized appreciation. But again, you can't do it once you've rolled it over into the IRA. Clearly, there are a lot of different ways to do things to hold on to your money, to create your income stream in retirement. And that's why we created the Masterclass for you. So if you want to take a look at it, when we're done with the video today, come back and hit the Masterclass to make sure that you can view how to maximize your retirement income and avoid some of those common mistakes. So let's go on to the fourth landmine. And this landmine deals with the pre-tax and the after-tax portion of your 401k. Now, some people have an after-tax portion that is in the 401k that once you roll it all over into your new IRA, you lose the ability to take some of that after-tax money out in a tax-advantaged way. So let me share with you what you need to do. First, you call your old financial institution, the retirement plan provider, and find out, let's say you have $500,000 in the 401k. Let's say $450,000 is pre-tax and $50,000 is after-tax. You could do two different things. First, roll over the $450,000 into a traditional rollover IRA, and then move the $50,000 into a taxable account. And in that way, once you pull the money from the $50,000, you're not taxed on it like you would be if you were to take the money out of the IRA. So be very aware of the pre and the after-tax monies within your 401k so you don't pay more taxes than you should. Landmine number 5. I referenced it a little earlier. If you are younger than 59 and a half and are retiring and you wish to take income from the IRA, your new IRA that you rolled over from the 401k. If you do it before 59 and a half, typically you have to pay taxes on the money that you take out plus a 10% penalty. However, there is a certain IRS code called Section 72T. It allows you to avoid the 10% penalty. Don't want to get into the technicalities of it, but it is something that we've utilized with our clients before. And again, it's important. Again, if you need income before 59 and a half and you've retired, Section 72T is a good thing to take a look at to help to avoid some of those taxes again. So those are the 5 landmines that we have. And again, if you liked this video, please subscribe to the channel. Hit the notifications bell below. I really hope you've enjoyed it. Send this video to a friend. Thank you very much, and I truly hope that you enjoy the retirement journey.